Market worries of a recession have made a comeback this week, and with consumer sentiments taking a turn for the worse, we take a look at what next week has in store for the markets. On the monetary front, we note a relatively quiet period in regards to monetary policymakers as Fed enters its blackout period before its May meeting. On a more fundamental note, we note the release of Riksbank's, Turkey CBT and BOJ's interest rate decisions on Wednesday, Thursday, and Friday respectively. As for financial releases, we make a start on a quiet Monday with Germany's IFO indicators for April on Tuesday during the European session. We note the UK CPI figures, and during the American session, the release of the US new home sales and consumer confidence figures for March and April respectively. On Wednesday, during the Asian session, we make a start with New Zealand's trade data for March, Australia's CPI rates for Q1, and in the European session, we have Germany's GfK consumer sentiment figure for May and the UK CBI distributive trades figure for April, while during the American session, we have the US durable goods orders for March. On Thursday, we note a quiet Asian session, and we make a start during the European session with Sweden's preliminary GDP rate for Q1, followed by the Eurozone's business climate, economic sentiment, and final consumer confidence, and Canada's business barometer, all being for the month of April. During the American session, we highlight the key release of the US GDP rate for Q1 and the weekly initial jobless claims figure. Lastly, on a very busy Friday, we begin during the Asian session with Japan's CPI print for April and preliminary industrial production rate for March. During the European session, we have France's, Germany's, and the Eurozone's GDP preliminary rates for Q1, UK's nationwide house prices rate, France's, Germany's preliminaries HICP rates, as well as Switzerland's COF indicator figure, all being for the month of April. During the American session, we note the US consumption adjusted rate and the core PC price index rates for March, followed by Canada's GDP for February and the US University of Michigan consumer sentiment. It's the final figure and it's for April. The USD is about to end the week relatively unchanged against the common currency, the pound, and the yen. On a fundamental note, we note that the Fed's beige book clearly stated that banks tightening lending standards amid increased uncertainty and concerns about liquidity, while also noted the weakening of the demand side of the US economy. On a macroeconomic level, we note the release of the S&P manufacturing PMI for the US, due to be released this afternoon, in addition to the US GDP rate for Q1, which is due to be released next Thursday, as they may verify the expectations of a slowdown in economic activity, as expressed by the Philly Fed Business Index data that came in much lower than expected for April, thus may further weaken the US dollar, should adverse releases emerge. Overall, recession worries seem to be elevated for the US economy and may provide some safe haven inflows for the greenback. On a monetary level, we note the mixed signals coming out of Fed policymakers, yet the lagging effect of the Fed's monetary policy may have an additional negative effect on the US economy, while we expect the bank to raise interest rate before actually pausing. On a fundamental note, we note that the British economy seems to be on track to contract in 2023. As such, the pound ending the week near the same levels against the dollar and the yen may not be a sign of pound strength, but dollar and yen weakness. On a monetary level, despite BOE MPC member Tenerero's dovish comments, we suggest that the bank may proceed with another rate hike at least for the coming meeting, if not beyond. On a macroeconomic level, we note the release of UK's CPI prints coming in higher than expected at 10.1%, which implies that inflationary pressures are rampant in the UK economy, and as such, the bank may need to take decisive action by raising interest rates further. On the other hand, the demand side of the UK economy seems to be weak, as the retail sales growth rate contracted for March, which could be considered a negative for the pound. Hence, we may see the pound fluctuating as the MPC debates on holding, cutting, or hiking rates in order to prevent the economy from entering a recession or to prevent further inflationary pressures. The JPY is about to end the week relatively unchanged against the common currency, the greenback, and the pound, recovering somewhat as market worries intensify. Overall, the JPY was facing safe haven outflows as banking earnings week in the US appears to be in relatively good shape, thus alleviating further banking fears, yet since Thursday is gaining as investors have started a flight to safety. BOJ Governor Weda last Sunday reiterated the need to stick to the ultra-loose monetary policy. On a macro level, we note the release of Japan CPI today, and it was indicative of reduced inflationary pressures in the economy as the rate had decreased for March on a core level. With the CPI print coming in lower than anticipated, we may see pressure on BOJ easing before next week's interest rate decision. The bank is widely expected to remain on hold, and should its dovishness resurface, we may see JPY slipping. Also note that this is to be the first interest rate decision of BOJ with Mr. Wert at the helm. The common currency seems to remain relatively unchanged against the US dollar, the pound, and the yen for the week, if not edging a bit lower. Fundamentally, we acknowledge the fact that the French protests are continuing, and they are about the most unpopular pension reforms, resulting in continued strike actions in France, which may weaken one of Europe's largest economies. On the monetary front, we highlight the release of the ECB's March meeting minutes, in which policymakers Lane and Schnabel had a rather hawkish rhetoric. However, we note dissent among policymakers, with some making the case to remain on hold in order to allow for a comprehensive reevaluation of ECB's macroeconomic policy. On a macro outlook, we highlight the contraction of economic activity in the manufacturing sector, not only in Germany, but for the Eurozone as a whole, as indicated by the relevant preliminary PMI figures for April. In the coming week, Euro traders are to have a busy week ahead as we get the GDP and HICP rates, which may provide additional insight in Eurozone's economic outlook. The Aussie appears to have remained relatively unchanged against the US dollar for the week. On a fundamental note, we give emphasis to the continued deterioration in the US-China relationship, potentially affecting negatively the Aussie. Please note that China's GDP for Q1 and retail sales growth rates for March both outperformed market expectations, yet the industrial production and urban investment growth rates undershot the market expectations, tending to create worries for Aussie traders. But also possible risk of sentiment in the markets may have an adverse effect on the commodity currency AUD. On a monetary level, we highlight the release of RBA's April meeting minutes, in which members acknowledged that the tighter monetary policy stance was gradually flowing through the real economy, thus implying that the RBA may remain on hold during its next meeting as well. But it's not definitive, as the purpose behind the hold was in order to gather additional data. Furthermore, heading into next week's financial releases with the CPI print for Q1, and should rates slow down further, we may see market expectations for a pause in RBA's rate hiking path solidifying. Across the world, the loonie weakened against the US dollar for the week. On a fundamental basis, we note that the weakness was intensified by dropping oil prices caused by market worries for the demand side of the commodity. Also, the risk of market sentiment added additional downward pressures on the CAD. Should that tendency intensify in the coming week as well, we may see the loonie losing more ground. Fundamentally, we know that a third of Canada's federal workers went on strike on Wednesday, weakening confidence in the Canadian economy, while on the monetary level, BOC Governor McClellan on Tuesday stated the bank's readiness to act should inflation rates accelerate, which seemed to follow last week's forward guidance that the bank anticipates that getting inflation to 2% would be more difficult. On a macroeconomic level, we note the higher than expected CPI rate on a month-on-month level on Tuesday, indicative of persistent inflationary pressures in the Canadian economy, adding more pressure on BOC to resume rate hikes. Furthermore, we also note Canada's GDP rate for February, due to be released next Friday. A lower than expected reading may weaken the CAD, as it may limit the bank's eagerness to hike, leading to the loonie weakening and vice versa. As a closing comment, following the Fed's beige book, the outlook on the US economy is grim as banks tighten lending standards amid increased uncertainty and concerns about liquidity, highlighting the increased risks of a recession looming in the financial markets, which may weaken the US dollar further unless safe haven flows come to the rescue. In the US equities market, the market sentiment has deteriorated following the earnings releases as market worries for a possible recession intensify. Earnings releases by various banks and corporations this week, despite the banking sector seeming sound, seemed not to excite traders, and we note some worries for companies not meeting the market's expectations, such as Alcoa, Netflix and Tesla, making a start on Monday. We anticipate Coca-Cola's earnings. Tuesday, we await the earnings, the release of Microsoft, followed by Google, Visa, PepsiCo, McDonald's, General Electric, UBS, 3M, General Motors, and Xerox. On Wednesday, we note Meta, Boeing, and eBay, while on Thursday, we anticipate Amazon and Intel. Given the high number of high-profile companies releasing the earnings reports for Q1, we may see the attention of traders increasingly shifting towards the US stock markets. Also, the hold of the weakening of the US dollar may provide a cautionary tale to gold traders to be on alert for possible reversal of its past upward movement. Gold seems about to end the week in the reds, displaying once again its negative correlation to the US dollar.
Welcome everyone to this webinar. Okay, so this is an IronFX webinar on fundamental trading strategy. This will be the part 2 of the series. Okay, so IronFX has a special partnership with EFG, Everest Fortune Group, where I come from. So my name is Ketan. So I'm an analyst with EFG. So we've been the finalists for best equity research and FX research in the following years, 2019 through 2021. So please, okay, so this partnership gives you all the latest analysis and insights to FX and also for FX and commodities as well. So you can find out more about this through our VIP room, right? Okay, so how do we get to the IronFX VIP room? Okay, so let's just switch over to my browser, right? Okay, so if you go to the IronFX homepage, right? Okay, so if you go to the IronFX homepage, look for IronFX School and click on VIP room, all right? So this is where you guys can join the VIP room or get access to the VIP room. What does it bring you, right? What do you guys get out of it? You guys get exclusive market forecasts. You get a opportunity to ask the experts as well, right? All the analysts and traders, including myself. You can also request for market forecast as well. So if you have any particular question about any currency pairs, you can see this GIF here. Feel free to drop a message, and we will definitely respond together with a chart and our analysis as well. Right. Okay. So how do you get access? Okay. So access is tailored for 5 different account types, as you can see here. Right. And this is how you do it. How to gain access to a VIP trading room in 3 easy steps. Okay. Once you guys have signed up, or I'm sure maybe some of you have already have signed up. So this is what the trading VIP channel looks like. Okay. So here we have the various channels, right? You have a chit chat channel, potential setups, trading videos, and you got news as well for the various pairs, and also the majors are seen here as well, right? Okay, so this is what the chat room looks like, and where we can do where you can drop us a message, and we will be more than happy to quickly respond with our analysis on your respective currency pair. Okay, so now that we've covered this, okay, let's just get the show going. Okay, so let's go back to the slides. Okay, right. Okay, so back to fundamental trading strategy. But okay, basically we need to get data, right? Information data, because we are looking at fundamental analysis. Where do we get our data from? So the good thing is a lot of the data can be found through Forex Factory, right? I'm sure many of you must be familiar with Forex Factory by now. If not, let's just quickly zoom over to that, the Forex Factory page. Okay. So here we are. This is all in GMT time, right? Okay, so it's all GMT time. So I'm looking at the dates from 17th of April to 21st of April, right? Okay, so this is where we can get, this is showing us the economic calendar. And from here, we get access to the data as well as the sources, right? So for example, let's just look at, okay, Canadian CPI, right, which came in on Tuesday, April 18, 12:30 p.m. GMT. So if you click on the chart icon, oh, okay, yes, what is this? Oh, hang on. Let me refresh this. Okay, sorry. Quickly refresh this. Right. Okay, yes, okay. Now this is working. So if I click on the chart, okay, so if you click on the graph icon, you can see the historical performance of that particular economic event. And if you click on the folder, it gives you a description, and you can also click on latest release. Okay, so if you click on latest release, it takes you to the respective website, and you can get, oh, why is this? Okay, and you can get more data here. Okay, so you go 18, where is it? Apologies. Okay. Yeah, okay, so here we go. Sorry. So I just needed to go to major economic releases, click on the 18th, and then we can finally look at consumer price index, right? So this takes us to the press release, and it gives us in detail what Canadian CPI was at the headline level and core level. Okay, so this is where you can get access to fundamental data through Forex Factory, which ultimately links you to the respective pages for that particular country and that particular data set. Okay, so now let's just, yeah, so this is the information resources. Okay, so before we continue, let's just do a quick recap. Okay, guys, if you have any questions regarding this recap, please feel free to drop a message, or if you like to revisit any of these items, please do let me know. Okay, so basically, when we look at fundamental trading for currencies, we have to look ultimately at what central banks are doing and what type of monetary policy actions they are carrying out. Okay, so basically, central banks conduct monetary policy by raising or cutting rates, right? And as we've seen over the past year and a bit more, major central banks all around the world have been raising interest rates in a battle to combat inflation. Another thing to take note of is also interventions, right? So what is intervention? This is when a major central bank steps into the open market to either prop up their currency if it's too low, or to try and reduce the value of their currency if they find it too high. So one example of this would be the Bank of Japan last year, right? Okay, so when the Federal Reserve started aggressively raising interest rates, the dollar rose strongly, the DXY index rose strongly, the dollar naturally also will rise. Well, the dollar started rising first strongly, which naturally pulls up the DXY as well, which is the dollar index. And of course, all the other major currency pairs against the US dollar started falling quite significantly. So because of this, the Japanese yen was getting over devalued, right? So the Bank of Japan had to step into the open market and buy the currency. So by doing this, they were propping up the value of the yen, and this is reflected in the price of the currency pair dollar yen. Right, so I think dollar yen hit as high as 152 last October, or 140, between 140 and 150. And after the BOJ started intervening in the open market, the dollar yen started pulling back quite significantly, right? Okay, so these are some things we need to take note of, and these are also some of the key economic data to watch out for: GDP, PMIs, employment report, inflation, which naturally takes over, which is taking the center seat now, and also government bond yields and the yield differential between the various um, countries, right? Okay, so let's just quickly. Okay, then. Okay, guys. Okay. Is there any questions on the recap? Okay, maybe I'll just cover. Right. Okay, maybe I'll just cover. I'll just go here and let's see. Okay, quickly cover bond yields. Okay, so we're talking about bond yield differential. So, for example, the benchmark bond yields that are commonly used are the 10-year bond yield. So, if you type US 10Y into your trading platform or trading view, you will get a result for United States 10-year government bond yields. Okay, so bond yields will react to what central banks are doing. So in a period where central banks are aggressively aggressively raising interest rates, you can expect bond yields to rise. And this was what was happening, or this was what happened in 2022 when the Federal Reserve started aggressively raising interest rates. Bond yields rose in tandem as well, going from as low as about 1.5% in January to as high as 4.3% in October. Right. So during this period, bond interest rates were rising, bond yields were rising as well, and the value of the US dollar was rising significantly against its counterparts, and hence the dollar index was also rising, right? And then after that, we had an intervention period in by the Bank of Japan because their currency was getting over devalued. So if you look at the dollar yen, so this is the daily chart of the dollar yen. So as you can see, in January, it was as low as 110, 113, right? 110, 113. It went all the way as up as 152, right? And it was during this period, and October, early November, where the Bank of Japan intervened in the open market to prop up the value of the yen. So when they do that, the yen strengthens versus the US dollar, and that is why dollar yen started to fall, right? Despite the Federal Reserve actively raising rates and the Bank of Japan having a very dovish monetary policy. Remember, the Bank of Japan's interest rate is still a negative 0.1%. Despite the vast difference in monetary policy actions by the respective banks, dollar yen started to fall pretty aggressively, in part due to the intervention by the Bank of Japan, plus other factors as well, which was falling bond yields, US bond yields as well, and and inflation data also had peaked, and US inflation had started to come down. So when you have all these factors in place, it drove down the price of dollar yen. So once you understand the fundamental uh, background of what's happening by paying attention to news, by looking out for interventions, by looking at inflation data, you are able to form an overarching view of what is happening with a particular currency pair. So in this case, for the dollar yen, we had an intervention by the Bank of Japan in end of October, early November. We had US inflation, which had peaked on an annualized basis and was falling month after month. And we also had bond yields, US bond yields, which were falling, right? So this is the chart of the US of the dollar yen. And if we were to look at bond differentials between the US and the Japanese government bond yields, we will be able to see a similar story as well. Okay, so if we go to TradingView and we search for US 10Y, which I told you, which is bond yields, right? So as you can see here, this is the daily chart of the US 10-year bond yield. So it peaked at about 4.3% in October, third week of October, and it moved, it fell pretty significantly during all the way till December. And it's been like ranging between 3.5 and about 4% recently. And then for the Japanese bond yield, you can look at JP10 Y. So this is the Japanese 10-year government bond yields. So despite the Bank of Japan keeping interest rates at negative 0.1%, bond yields were trading differently, right? So everyone looks at the 10-year because that's the benchmark uh, duration. So as you can see uh, here, bond yields spiked. Well, yeah, okay, they held pretty steady here, but they really started spiking in December. So if you want to if you want to see or visualize the bond yield differential, it's very easy to do so in TradingView. So you just take US 10Y minus JP 10Y. So this will give us the bond yield differential between US government bond and the Japanese government bond. So as you can see, this bond differential uh, mimics very closely to the price action of the dollar yen. So once you understand the fundamental background of for this currency pair, so we mentioned intervention by the Bank of Japan. We mentioned falling inflation figures coming from the US, and we also talked about falling government bond yields in the US. So when you factor all these uh, pieces of data together, you can form an overview of what is happening with this particular currency pair, and then you are able to determine what sort of uh, positions you would like to take, right? Okay, so and also yes, okay, just as a reminder, anything that is discussed in this webinar is purely for information and educational purposes, right? Please perform all due diligence before putting on any trades. Okay, I think I skipped that part at the start, so apologies for that. Okay, so as we mentioned, once we know what's happening at a fundamental level between the US dollar and Japanese yen, we'll be looking to short the dollar yen. So if I go back to dollar yen here, this is the daily chart. You'll be looking to short the daily yen, the dollar yen based on uh, using technical analysis. So once the fundamental uh, analysis has been done, we move on to TA, technical analysis, and then using that, we would identify short positions in this pair. So this is a daily chart, but naturally we can scale down to the 4-hour chart and 1-hour chart, right, to identify suitable entry and exit positions, right? So this is how we combine the fundamental data and use TA to identify entry and exit points. Okay, so let's just okay. Okay. Just this is just a quick going back to the slides, just a quick list of the major central banks around the world and their abbreviations, right? So we have the Federal Reserve, which is the Fed, ECB, European Central Bank, BOJ, SNB, Bank of England, Bank of Canada, RBA, RBNZ. Okay, I'm sure all you guys will be familiar with this. So we can quickly skip through this. Okay, the dollar index. Okay, so how did the dollar index come about? Just a quick review of this. So this was in 1973 when the Bretton Woods Agreement was dissolved, right? So the US was pegged to the price, the value of the US dollar was pegged to the value of gold, and all the other global currencies were pegged to the value of the US dollar. But now in 1973, the agreement was dissolved and the dollar index was created with a base set at 100, and these are the components of the dollar index, right? So at that, so we had the euro, Japanese yen, pound sterling, Canadian dollar, Swedish krona, Swiss franc. So as you can see, the weightage has not changed since then. So the euro constitutes 57% of the basket, followed by 13% for the yen, 12% for the pound sterling, and so on and so forth. So what this tells us is if the dollar index is rising or falling, then it's very likely that the euro will have an opposite reaction in price, since it's making up more than 50% of the basket. So if you see the dollar index rising aggressively, we it is natural. It is definitely going to reflect in the price of the euro, which will be falling, and vice versa. So this is why you will see the most impact on the euro versus the other currency pairs, right? So maybe Japanese yen may not move as much in relation, but because of the euro has a much larger weightage, so the dollar index is would have a major impact on the price of the euro. Okay, right. Okay, so going back to inflation. So last week we had data from the US, right? We had PPI and CPI data which were released last week, and prior to that we also had ISM PMI prices released. So uh, ISM is the Institute for Supply and Management in the US, right? It measures the manufacturing and services activity of the US. So there are many sub components in that index, and one of them is prices. Okay, so ISM data is usually released 1 week ahead of inflation data in the US. So what we see here in this chart is the blue line depicts CPI year over year, so which is annualized headline CPI readings, versus the red line, which is the ISM prices average. So because I said ISM surveys have two components, or because it measures activity in two different sectors, manufacturing and services, it takes the average of the prices sub-index in each of those categories, right? So what you see, the red line is the average price uh, price index in between the services and manufacturing sectors of the US. So you can see clearly that the red line leads the blue line. So what this tells us is that ISM PMI prices, the average of it, tends to lead CPI prices uh, over a pretty long duration, right? So this starts in 2023 or 2003 all the way to 2023. So you have 20 years of data here and historical performance to show you that to the upside and downside, ISM PMI prices tend to lead CPI prices. So if we know, for example, coming back to something that's relevant in early 2020, and throughout 2021, you can see ISM prices uh, were rising significantly, well ahead of CPI. Okay, it's important to note that both of these data are released on a monthly basis, right? Unfortunately, it's not as fast as we would like the data, uh, the official data to be released, but it is still a very good proxy to determine how quickly uh, US overall headline inflation, US data will rise as well. So ISM rose pretty strongly, and then after I would say 2 to 3 month lag, CPI data also started to rise quite significantly. And it's very obvious here in the chart. You can see that ISM prices peaked first and started heading down, and then 1 to 2 months later, headline CPI peaked, and then it followed suit. So when you can see this fundamental data changing or turning, so basically this is a turning point. This happened in the second half of 2022. So ISM prices average were already telling us that inflation on an annualized basis is about to drop. And this is reflected in bond yields and the price of the dollar index. So this is when the dollar started to weaken against majority of its pairs. So this is where you would be looking not to go long for the majors, but you'll be looking to go short in favor of the counterparty, right? So this is when you would see would be the topping point of the dollar index, and hence with the dollar index falling, you would expect the euro and the pound to rise, right? Okay, so basically, uh, pound dollar will fall, euro dollar will fall, right? Oh, sorry, my bad. Okay, when just to recap. So in this period, with inflation rising, dollar index was rising. So so euro dollar, pound dollar were falling in this scenario, right? And dollar yen was rising on the upward movement. And when inflation peaked and started falling, led by ISM PMI prices, the dollar index peaked and started falling, and hence the euro dollar and pound dollar bottom and started rising, while the dollar yen peaked and started falling, right? So once you are able to use inflation data such as this, and together with watching bond yields and bond yield differentials, you would have identified that this is a major turning point for the dollar index, because inflation is falling, bond yields are falling, and the dollar index is weakening, right? So this is how you would use this fundamental data to identify uh, current trends, right? Current inflation trends, current strength of the dollar, and also potential turning points. Okay, so as you can see, these are the CPI charts as well. So you can see here we have headline CPI in dark brown or dark red, and we have uh, core CPI in slightly in a lighter shade. So you can see headline CPI has peaked and come down pretty strongly, whereas core CPI still remains relatively sticky. So if you see the news headlines about inflation being sticky, or core CPI inflation being sticky, what they mean is that it is actually uh, consolidating at a certain level and is not falling as fast. So despite peaking a bit later, core CPI is now actually pretty flat and is not falling as quickly as headline CPI. So that's what they mean by sticky CPI. Okay, so the core is all items less food and energy. So what is the core CPI made up of? Okay, the core CPI is primarily made up of shelter and services components. So shelter means your home prices, your rental prices. So these components are not falling as quickly as they should, and services also are not falling. So if you look at the ISM PMI surveys for manufacturing and services, you can see the services sector is running pretty strongly in the US. Okay, so that means the data is showing that the services sector is expanding, continuing to expand, whereas manufacturing is slowing down. So you can see that's why services have yet to peak here as well. So when demand is strong, when services activity remains strong, that means demand is strong. So hence we don't expect prices related to services activities to fall or to peak. So it's very obvious we don't see it here. Okay, what we see is in PPI. So PPI is producer price index. So this is related to the mostly to the manufacturing sector. So you can see headline PPI and core PPI has peaked and has fallen very significantly. So that is also because in due to the slowing down of the manufacturing sector of the US. Right. Okay. So in the first half of last week, we had softer CPI data and PPI data, which actually drove a majority of the moves. Right. So we had. Okay, let's go back to a chart. It's always easier to view and explain this through a chart. Okay, so let's look at the dollar index. Okay, so now we are on a 1 hour chart. So last week, okay, let's just do a 4 hour chart first. So yeah, so last week was, yes. So Tuesday, 11th April, we had CPI data that was released. And then on the next day, on the 12th, we had PPI data as well. So softer PPI data and CPI data basically means that in the current reading is lower than the previous month's reading, and also very likely it was lower than the estimate. So when you have a scenario like this with inflation data coming in softer than previous months, this would lead to a fall in the dollar index, which you can see here pretty clearly. So 11th April in this candle here, 15. Okay, this is, let me just put everything back to be consistent with Forex Factory. I'll put everything back to UTC plus to 0, which would be any of these. Okay. So, okay. So in this 4 hour candle, you could see this was the period where CPI data was released. It came in softer than expected, and price went down. So basically, ISM prices were telling us that CPI data is likely to come in softer. So hence, you in advance, you would have been able to take using technical analysis, being on a 4-hour chart or 1-hour chart, you've been able to identify support and resistance levels, and then enter your trade accordingly, and and put your levels to put your stop loss levels accordingly, and enter the trade, knowing that ISM prices data was telling us in advance that the CPI data that was to be released on 11th of April is likely to come in soft or come in lower. And that's why we had this big move down here in the dollar index, and followed by the next day, yes, on the 12th, where PPI data was also released. So you had two sets of inflation data, which was signaling that inflation was coming down in the US, and hence the value of the dollar index fell, and bond yields also fell as well. Remember, it is important to note what bond yields are doing, especially the US 10-year bond yield, because that will give us a sense of inflation expectations by the market, right? Although inflation is falling, but also it is also important to note what is the inflation expectation. And generally, this is uh, embedded in the level of US 10-year bond yield, right? It's a good proxy. Is not reflected purely in that bond yield itself, but it's a good proxy to determine what inflation expectations are. So that's why bond yields play a very big important in determining um, overall currency pair movement. So look at bond yields, the 10-year bond yield for each of the major currencies, right? And also look at the bond yield differential between the currency pair that you're interested in, right? And I've showed you how to um, do the to look at the bond yield differential in TradingView, right? It's very simple. Just look for the ticker and just use. So if it's dollar yen, right? Dollar yen, you will take the US 10-year minus JP 10Y. And if it's Euro US, you would look at EU 10Y minus US 10Y, right? And for the pound, okay, let's just look for the pound. UK is it GP? Hang on. B. Yeah, so it is GP10. Okay, so GP10Y minus US 10Y, right? Oop, what happened? Do I not? Oh, sorry, I didn't put in the minus. Hang on. Minus, yes, okay. So yeah, so this is how you calculate, or well, not calculate, but this is how you would plot bond yield differentials. Okay, so going back to the dollar index. Okay, so as you can see, and it's also important to have to do a top-down analysis, because when you look at the daily chart on the dollar index, you can see that 100.82 is a very important support level. Now, why do I say that? Because after dollar peaked in September, the dollar index peaked in September, it ranged between, what is this, 110 and about 113 over a month or so before it started pulling back aggressively. And it came down all the way as to a low of 100 and 100.80 in early February. And this is where price bounced, or bottom rather, and moved up. Now, this could be due to quite a few factors, right? Because after such a big move down, well, did this price come going back earlier? No. Okay, so if we move back a little bit, zoom out a little bit more, we can see that this is the first time price has bounced off this level, right? It's the first time the price has bounced off this level. Although it came very close in May of last year. So when price moved off here, this is something that we can identify as a pretty important support level. Okay, so on a daily chart, uh, it's important to zoom out to identify important overlapping support and resistance levels, so that we can understand what happens when price price comes very close to these major points. So over here, it could be a combination of profit taking as well, right? So after a big move in the dollar index, people were short the dollar. To realize your positions, you had to actually buy. Uh, you have to buy to close out your trade. So whether you were uh, long, okay, whether you're short dollar yen, for example, if you're short dollar yen, you would be buying the yen. Sorry, you'll be closing out the trade by uh, selling yen and buying the dollar, right? And conversely, you would be if you were long euro pound and long euro dollar and pound dollar, you to um capitalize on those gains, you would need to sell, right? So you'd be selling the euro, buying buying the dollar, selling the pound, buying the dollar. So you have a scenario where possible profit taking took place, as well as other uh, macro fundamental data that would drive up the price of the dollar index as well. And naturally, this is the period where bond yields for the US were probably rising again as well. Okay, so it is important to zoom out to identify certain levels. So this is brings us to uh this to middle of March, right? So middle of March, we had the dollar index peak again at almost 106 and started making its way down again, right? Okay, so during this period, it was also the period where we had the Silicon Valley uh, banking crisis, right? We had the Silicon Valley banking crisis, Signature Bank, and there were a few other factors that were going on in the background as well. So dollar index was on the downtrend once again, right? And then this, and remember to note that, because okay, why was there this level to keep out on? Okay, there were also several other levels, so you can see here as well at about 101.5. You can see here that on a daily chart, price had actually price action had actually respected this level here, as you can see. So even in the towards the end of January, price somewhat bounced off 101.5 on a few occasions. We had here on the 18th, also on the 23rd of January, also here 25th and 26th. So you can see price had relatively bounced off here a couple of times. So this would also have been a potential support level that you can identify. And then it broke through that level on the 1st of Feb and made a new low on the 2nd of Feb. And then price rebounded from here. So on the way down, it is also important to note several uh, levels of resistance and support. So what we like to look at here is overlapping areas of support. So what do I mean by overlapping? So okay, let's just go here. So if you look here, if I would just want to draw a line. Okay, actually, hang on. I can extend this current line here. So, okay, let me just do this here. So if you can see here, so this will be, okay, wait. Sorry, let me do a replay. It'll be easier. Okay. Yes, okay, let me do a replay till here. Okay, so let's just say we are back in January 2023. Looking at the daily chart, you can see price action on a longer time frame had bottom around 101.5. And when you zoom out, you can also see that, like I said earlier, similarly in May of 2022, price had bottom around 101.20 and moved up. So this is a relatively important support level. Okay, so let's just draw a line here. Okay, so let's just put this as, okay, let's just put a, sorry, let's just, I'm not going to label it anything, but I'm just going to color it in green so that we know that this is support level. Okay, so as you can see, okay, of course, over the periods of time as price went up, you would been able to identify various support levels as well. So this also was another support level that you would have identified for a longer term trend. So you can see here 105.3 price bounced off here in August. It tested it in uh, November a couple of times before it finally break lower. So you can see that even here 105.17, that price has rebounded off this level and it went a bit higher first before retracing, testing it, going higher and coming down. So just let me draw another level here as well. So where did I see? Yeah, it's roughly okay. You can do the wicks or you can do something that just the body of the candle, right? So you can see here the body of the candle stayed above the support line, made a move higher. The dollar index made a move higher. Then on the way back down, although it didn't the wick didn't exactly touch this support level, but you can see price has reacted off it and gone up, came back down again, reacted off it again to go up, and then it finally broke through, consolidated, and went down. So it's quite important to identify this sort of overlapping support and also resistance levels as well. So okay, so once we had, for example, identified this level here, so on the way down, you can see where the next support is, right? So if you do okay, let's just play. So you can see, yes, it came, broke through that level, made a new low, finally went up, retraced, broke, because now once um this level, which identified at 101.30 had been broken, we can say that this level doesn't hold any major significant support, right? So once it has broken it, you can remove this and try and see if the new support forms any other overlapping level. So going back pretty far, almost a year ago, there was no major support level to align with. But you can see here as time, uh, as we come into April, you can see that price has reflected this level quite strongly, right? So the dollar index bounce made a January high, yes, yeah, made a, well, not January high, 2023 high in March, early March, before pulling back again. And as you can see on the 13th of April and 14th of April, on a daily candle, the wicks respected this level and price has bounced up. Right. So this is also how we use overlapping support levels on a daily chart to identify important support and resistance levels and to see whether price is respecting these levels or are they breaking through them, right? Are they reacting in a way that they bounce off the support and resistance, or are they actually breaking through the support and resistance? Okay, so this is how, so once you have identified uh, or once you have performed your fundamental analysis, then you can start by doing a technical analysis on a daily chart, zoom out to see periods of over months on a daily chart to see what is the actual price trend. Are we in a bull market for the dollar index? Are we in a bear market for the dollar index? And then try to identify various support and resistance levels. Okay, so let's go back to something uh, more up to speed, so more current, right? Okay, so as you can see, that is why we have set this level here, 100.80 as a major support. And by also using Fibonacci, we took the high of 8th of March to the low of 14th of April to do a Fibonacci retracement. And from here, we can see that the first level of resistance would probably come in about 23.6%, right? So after making this low here in middle of April, sorry, we would expect price, if price were to bounce off this level and come back, we would expect it to at least retest 23.6% Fibonacci. So let's zoom in now into the 4-hour chart, right? So if you look at the 4-hour chart, so on 14 April, price bottomed at this major support, which was identified earlier. It bounced up. And when we look at the Fibonacci retracement here, looking at 23.6%, it came, yes, it actually broke through the 23.6%. But also, when you look at the level, right, at 23.6%, you are able to also identify another resistance level by looking at the candles, right? So these are we're looking at a 4-hour chart. So you can see here, price bottom on 22nd March, moved up, came back down again close to this level at the end of March before going higher. So you can see here that we would have identified this as a potential support line as well back then. So we do a replay, right? We do a replay. Oops, hang on. Oh, sorry. Right. So we do a replay. So after seeing that price had bounced around this level, it came up and started trending lower. You could see that, okay, you would have put a support level here. You could do it right at the bottom of the wick, or yeah, maybe yeah, at that point in time you would have put it right at the bottom of the wick. Okay. And then we could see that price respected this. At that time, this would have been a support level. Price respected the support level, and it moved up. So if you press play, you can see it moved up. It respected the level again for a few hours, right? Probably about half a day. It respected this level again, right? So from 3rd of April till yeah, so a day, right? So basically about 12 hours or so, price respected this level. It bounced up and then it finally broke through. So it is also important to note such levels so you know where to potentially take profit if you had been short, right? If you had taken short positions from 102.5 onwards, for example, right? 102.80. If you'd taken a short position from here, you would have seen that, okay, this appears to be a major support level. So I'll be looking to close out my shorts around close to this level. Okay. And also, okay. So, and also, um, if you were to look at, okay, so this is again for hourly charts. So if you were to look at the price action here, you could see that, right, this is a descending, this is a trend line here. So let me just move this trend line up. So we can also use trend lines here on the 4-hour chart. So as you can see, to identify where price is also being restricted, right? So we can also use a downward trend line here. So initially looking at the 4-hour chart, you would have seen that, okay, price is respecting it. So you would have been, you would have been plotting this line here, right? So as you can see, as price came back down, you had big wicks up as well, but price didn't really actually break through this trend line, right? And so you can see then you would expand, then you would have seen, okay, over here. So over here, together with support and resistance levels, you have seen that the price had bounced, made a bottom here, and also broke through this before reversing. So we would like to use primarily overlapping resistance and support levels, and then try to look at Fibonacci to fine tune those levels, and also to try and see like a trend line as well. So you can see if we use the trend line with this as the next point, you can see that price has respected it all the way pretty much, except here in middle of April, right? where price broke through, and we would have seen whether this would have resulted in a breakout, but actually it didn't, and it came back under the trend line again as well. Is there, oh, sorry, there's a question by Joe. Yeah, is there a recording for this webinar? Yes, I believe so. Yeah, I think that this would be on IronFX website as well. So do get in touch with them if you are not able to find it on their uh website. But I do, yeah, this is definitely being recorded, and I'm sure they'll be putting it up on their website pretty soon. Okay, Joe, I hope that answers your question. Yeah, and feel free to stop me at any time if you wish to have any other if you have any other questions. Okay, so if you then we saw price breakout, and then you would adjust the trend line again. Similarly, it broke out again out of this trend line in 17th of April, so earlier this week, and then it came back down again. And now with the recent price action, especially today, it has broken out of this upward trend line. But more importantly, it has actually uh, moved through several uh, overlapping support and resistance levels, right? So we had identified this 100.82 support level as an important support level that was formed back in February this year. So price has respected this level and rebounded from here. And there's also Fibonacci. Okay. Price has rebounded from here. And you could also say, okay, like going, let's just do another replay. So if you look here, oops, hang on. Sorry. So if you look here, so you could also back then, before coming down to this level, on the 4-hour chart, you could have identified this is also another possible support level, right? So if you can see here, this level actually has been respected in February, 3rd of February, and also then it respected this level here on 5th of April, where the dollar index bounced off this level and trended higher. Then after that, it came back down again. And okay, this also would have been our resistance level, right? Because you can see here we have a price action here and it bounced off this level. It came back down close to it, close to here for the second time, bounced up, and it finally broke through. So when it finally broke through, this was initially a support level. And once broken, became a resistance. So you can see it formed a bottom here. So in retrospect, this would have been a new support level. And then this would be the existing resistance where price respected it. And before finally breaking out higher and coming back down again, which the resistance became a support again. And then finally it broke through where it now has become a support, and we have this became a resistance, and we have the support here. So you would have seen that this level is also pretty significant. So when you zoom out, you can see that, okay, price has bounced off this level once over in February and second in April. So you would expect that if you had uh, taken short positions on the dollar index from April onwards, right, you would have seen, okay, this is probably a decent area to close out the positions and lock in some profits. So if we had continue on, so this time actually the price actually broke through, right? It didn't uh, um, rebound and bounce off this level. So this is, although see, uh, analysis is never perfect, right? So, but so what you can do is either if you are short, maybe you would have taken out the whole position and you would have missed out this move. Or if you are short, you maybe would have taken out half of your position and let the other half ride. But see, it always it can always goes both ways, right? You could have an instant. This was the instant where price actually broke through the support and made even made a further low, or you could have instances where price would have rebounded from this level, and you would have been the price would have been going against you, right? So it's important to note the support and resistance levels, and no action is ever perfect, right? Whenever you've done, no matter how much fundamental analysis and technical analysis we perform and we identify support and resistance levels, uh, we can have it is we can never get the perfect execution for trades, right? Whether be it on the entry or the exit. But we have to hope, not hope, sorry, we have to analyze, perform an analysis in such a manner that we can maximize our returns, right? We need to identify high probability setups, and high probability entry and exit points. Okay. So if price broke through this level, right, as we saw on 13 April, now you could see, okay, this is a big move through. You could have, we could have potentially, in retrospect, say, taken a short position here at about 100 and 130, with a stop loss probably just above the new resistance level, right? This would have been a resistance level. Potentially take that and then look to exit at the support which was formed back in February. So this time round, by closing the trade around this support level, you would have probably maximized your return on this short trade here. Conversely, if you had decided not to take out, close the position or close at least half the position, this move would have taken you back to our break-even point and was back to the stop loss level. So like I said, uh, there's never perfect execution when it comes to uh, entries and exits, but we have to do our analysis uh, in such a way that we give ourselves the best probabilities and the best odds of uh, a winning trade. Okay, so this brings us back to last Friday, 13, 14 of April. Okay, so on that day, 14th of April, we had a few um, other data news that came up. Okay, so we had US retail sales and we had bank earnings, right? There's three of the major big banks were reporting earnings that day as well. And we also had University of Michigan Consumer Sentiment Index survey out as well. Okay, so US retail sales. Okay, so for the last 2 months, so on February 14, April 14, sorry, data for March was released, which showed that retail sales fell 1% on a monthly basis, following a negative 0.2%. So when retail sales falls, we can assume that the consumer is spending less. So if the consumer is spending less, demand is falling. So hence prices should remain stable, or prices for goods and services could probably even drop. So this is actually good news on the inflation front, but actually price reacted very differently to what you expect, to what was in the data, because actually the devil was in the details, where core retail sales, which this one only excludes auto, but there's another subcomponent that excludes auto and gasoline, that didn't fall as much. So what uh, market participants uh, inferred was that core retail spending is still relatively strong, together with strong earnings from banks. Okay, so banks, the three biggest banks to report on Friday were JP Morgan, Citigroup, and Wells Fargo. Okay, so EPS is just earnings per share, which is the net profitability of the bank. Revenue is the total revenue, and this were the bank results, earnings results for the first quarter of 2023. So not only did these three big banks beat the estimates on the EPS front and revenue front, they also raised their forward guidance. What does this mean? That means they raised their earnings and revenue estimates for the second quarter of 2023. So that means from April, uh, May, and June, whatever earnings and revenue they gained during this period, they have actually revised up these figures. So this means that the banking, despite all the turmoil that we saw in early March regarding the banking crisis, the regional banking crisis, and potential spillover to the rest of the banking sector and eventually to the rest of the US economy. Actually, all that has been put to dust by the earning results of these three banks and their forward guidance. And I think if you look at bank results this week, at least the big players, they've, I think, even Bank of America, I believe yesterday they have announced their earnings. They also beat estimates and have given relatively good forward guidance. So this tells us that the banking sector is not fragile, it is actually strong. And this means that the Federal Reserve can actually still squeeze in one more interest rate hike. So that is why it appears that with the fact that core retail sales didn't fall as much, bank earnings uh, was strong, forward guidance was strong, which was why we saw dollar index reverse again, right? So this was the period where, yes, okay. So this was the period here where retail sales were announced. Bank earnings were released at about uh, what time was it? Bank earnings would be 1 p.m. roughly about 1 p.m. GMT, if I'm not mistaken, between noon and 1 p.m. GMT. Bank results were released, followed by retail sales. So with these pieces or this two data points, right, the markets had inferred that the US economy is still strong for another rate hike. So that uh, caused the bottom in the dollar index. And also remember when traders or institutions take short positions on the dollar index in order to capitalize on their profits, they have to close out the position by buying back the dollar. So they bought back the dollar based on the data points, and that caused a short covering rally in the dollar index. And not only that, because we also had at that around at the second half of, okay, so US 10 Eastern time, so about 2 p.m. GMT. 2 p.m. GMT was when we had uh, the University of Michigan released its survey findings, and one of the components was consumer inflation expectations, which actually came in higher than expected. So the consumer inflation expectation figure came in at 4.6% versus the estimate of 3.5%. So you had three different data or fundamental data points that drove the price of dollar index higher. So that's why Monday we had a strong move in the dollar index as well. Okay, we had a very strong move in the dollar index as well, which broke through several resistance, or which broke through this resistance level at 102.11 before it so it broke through not only the horizontal overhead resistance levels, but also broke through this downtrend line, and then it came back down again. So, okay, today's move could, I think it's very likely attributed to the inflation data coming out of the UK and the EU. Okay, now this may sound a bit strange, but why would inflation data out of these two areas have such a big move in the dollar index? Okay, so UK. So if you go, let's go back to Forex Factory. So we can see here. This is no, we want today, and we also want to see. Okay, wait, euro. Although why I have no idea why Forex Factory labels Eurozone CPI at a lower level than UK, but okay, nonetheless, what we can see here is for UK CPI and core headline CPI and core CPI on annualized basis, although they came in, headline CPI came in slightly lower than the previous month, it actually came in higher than forecast. So it didn't cool as much as estimates and actually came in a little bit higher. And core CPI was actually in line with the previous month, but came in higher than estimates. So this points out that the UK, that inflation in the UK is not falling as quickly as it should. And it is actually, especially the core is quite sticky. So this is what we mean is sticky. See, the core is not falling compared to the previous month and is not falling as much as forecast as well. And similarly, in the Eurozone, we had the final readings for CPI and headline CPI as well. So everything actually came in line. So you can see that CPI has not fallen in the month of March on an annualized basis. So I think this has raised inflation fears coming out of Europe, and also together with the consumer inflation expectations from the US last week. I think this has caused another bid for the dollar index. And also we can see this price action being reflected in the performance of the US 10-year bond yield. So this is the 4-hour chart for the 10-year bond yield. So as you can see here, Friday 14th. Okay, so going back to last week, you could see bond yields rising again. So usually when bond yields rise quickly or as strongly as they did here, so you can see this 4-hour candle is a pretty big move. It usually means that dollar index is rising along with it. And similarly here, Monday as well, Monday with a strong move in bond yields as well. And then after that, it bond yields stepped out at about 3.6%. The move was exhausted. They fell, pulling down the dollar index with it. But here, together with the inflation data coming out of Europe, it appears that bond yields have risen strongly again, causing the dollar index to rise as well. Okay, so this is why it's quite important to track the 10-year government bond yields for the respective currencies or the countries, and it's also important to track the bond yield differential between the currency pair that you're looking at. So I think this is why the move in dollar index came in very strongly this afternoon, or rather this, well, depend on where you are, right? If in Asia would have been late afternoon, if in Australia would have been early evening, and in Europe, naturally, it would have been in the morning, right? Yeah, so I think today's moves fundamentally seems to be resurgence in bond yields driven by inflation fears seeping back into the market. Right. Okay. So now, as you can see now that price action for the dollar index has broken out of this first resistance, this would now probably be the immediate support here, right? This would probably be the immediate support. And also, okay, another thing to note that once price rebounded from here, and after seeing the next candle come down on the 17th of April, you could have done a Fibonacci retracement here as well. So let's just zoom in a little bit. Okay, so we have done the Fibonacci retracement here. I'll just oops, hang on, where is it? Okay, yeah. Let me just do all fibs so you can probably see it more clearly. Okay, so from this bottom here at 100.83 to this move here 102.24, and after the next candle started falling, you could have done a Fibonacci retracement here to see what were the next immediate support levels, right? So 23.6% would have been the next support level, which also, okay, just an individual support level, but you can see that it also, does it line up with anything? No, okay, it's sort of, you could say it's sort of close to what was previously the resistance level, but it actually broke through that. And actually price respected the 38.2 retracement levels over a day, right? So you could see price has found support here, and then finally it has moved up as bond yields are rising, and as inflation uh, fears looks to have re-emerge into the markets. Right, so this is how we can also use Fibonacci to identify uh, support and resistance levels as well. Okay, so I will go back to this. So here I'm just showing the 50% retracement, and you can also see the 38. So if 38 had been broken, the next level we would have looked at would have been the 50% Fibonacci retracement level, which also lines up as an overlapping support here, because you see price consolidated at about 101.5 in middle of April. It also consolidated around this level at early April as well. And then also, if you zoom out, it goes all the way back to the February low on the third. So this is how we use overlapping support and resistance levels to identify major, I guess, barriers for price, and we could also use it in conjunction with Fibonacci retracements as well. Okay, so okay, I think I've come pretty much, yes, I've pretty much come to the end of today's presentation. So I hope this has been useful. Do you have any questions? Right? If there's any questions, feel free to um to 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 drop them in the chat. Okay, and maybe just before I end, I would just quickly just recap everything that we've covered. Okay, so basically this was a series on fundamental trading strategy. So where do we get the data from, be it economic data or surveys, PMI surveys? So if you go to Forex Factory and you filter according to the respective currency pairs and the high impact events, you are able to look at the data over the periods that you want, and then from there we're able to get all the relevant links from Forex Factory. So you can get, these are just a few of the links for respect to the US. So you can get GDP data from BEA, you can get ISM PMI surveys from ISM World, you can get the employment data from BLS, which is a Bureau of Labor Statistics. From the BLS, we also get CPI and PPI data. And then also, we are from the Federal Reserve website, we're able to find out the calendar as well, and the schedule of the calendar, when the meetings are coming. So just to quickly recap, so we have to pay attention to monetary policy by central banks. Are they in an environment where they're cutting rates, raising rates, keeping or just pausing and keeping rates neutral? Are there any major interventions by central banks? One clear one was the Bank of Japan last year, towards the end of last year, in the last quarter of 2022, around October, November, where they intervened in the open market, right, in the open currency markets by buying the yen aggressively to prevent it from devaluing further. And then we look at key economic data. We've shown you where you can get the data from. And right now, the overriding economic data point is inflation, right? That seems to drive most of the moves, although you cannot discount PMI data and employment report data as well. We've also talked about government bond yields. So the benchmark bond yield to use is the 10-year bond yield. So that's the duration that everyone tracks. And it's also important to uh, look at the bond yield differential of the currency pair that you're trading as well. So I've also showed you how to do that in TradingView as well. Okay, so yep. Okay, so I've come to the end of the presentation or today's webinar, sorry, rather. So, okay, if there's any questions, feel free to drop them. Otherwise, I'll just hang around for another minute. If I don't see any questions coming in, I will, yeah, I will just exit. So, okay, if you have questions, please send them in. Otherwise, thank you for your time, and I hope this has been a great session. And remember, please perform all due diligence prior to putting on any trades, and any information in this webinar is purely for educational purposes. All right. Okay. Thank you, everyone. Have a great day and have a great second half of the trading week. Okay. Take care, guys. Bye.
Everyone, my name is Emily. In today's session, we will look at news trading on economic releases. This trading strategy is appealing to many short-term forex traders. As markets move because of news, the release of economic data is often the most important catalyst for short-term movements. Basically, this trading strategy involves trading around significant forex news events, such as key economic releases from the countries whose national currencies consist of the major currency pairs. Because of the strong influence on a currency's valuation, a forex trader can take advantage of an important news release to potentially benefit from those fluctuations. There are 8 major currencies available for trading, so there is always a piece of economic data scheduled for release that forex traders can use to make informed trades. 7 or more pieces of data are released almost each weekday, except from holidays, from the 8 major most followed countries. Therefore, for traders who choose to trade news, there are lots of opportunities. As the US dollar is on the other side of 90% of all currency trades, US economic releases tend to have the most noticeable impact on forex markets. If you want to trade news successfully in the forex market, you need to know when reports are expected and understand which releases are most important under the economic conditions at the time. Generally, the most important information relates to changes in interest rates, inflation, and economic growth, like retail sales, manufacturing, and industrial production. To sum up, it's important to do your research and stay on top of economic news in order to reap the rewards. Thank you so much for watching us today, guys. Bye-bye.